Welcome to Stock Wars. For the second time ever, we have a battle between three dividend stock combatants that will determine who seizes intergalactic supremacy and is the most attractive healthcare company going forward. The first Stock Wars combatant is Pfizer. The company was founded in 1849 and is headquartered in New York City. Pfizer discovers, develops, manufactures, markets, distributes, and sells biopharmaceutical products worldwide. The company is also involved in the contract manufacturing process. It serves wholesalers, retailers, hospitals, clinics, government agencies, pharmacies, and individual provider offices, as well as disease control and prevention centers. The company has collaboration agreements with Bristol Myers Squibb, Astellas Pharm, Moyovant Sciences, Axia Therapeutics, Merck, Valneva, BioNTech, Arvinas, and of course Synapse. The second combatant is Bristol Myers Squibb. The company was founded in 1887 and is also headquartered in New York City. Bristol Myers Company develops, licenses, manufactures, and markets biopharmaceutical products worldwide. The company offers products in hematology, oncology, cardiovascular, and immunology therapeutic classes. The company sells products to wholesalers, distributors, pharmacies, retailers, hospitals, clinics, and government agencies. It has collaboration agreements with Pfizer, Otsuka, Nektar, Aveo, Darwin Health, and Bolt. The third combatant is Merck. The company was founded in 1891 and is headquartered in Kenilworth, New Jersey. Merck operates as a healthcare company worldwide. It operates through two segments, pharmaceutical and animal health. The pharmaceutical segment offers human health pharmaceutical products in the areas of oncology, hospital acute care, immunology, neuroscience, virology, cardiovascular, diabetes, and women's health, as well as vaccine products. The animal health segment discovers, develops, manufactures, and markets veterinary pharmaceuticals, vaccines, and health management solutions and services, as well as digitally connected identification, traceability, and monitoring products. It serves drug wholesalers and retailers, hospitals and government agencies, managed healthcare providers such as health maintenance organizations, pharmacy benefit managers, and other institutions, and physicians and physician distributors, veterinarians, and animal producers. Let the battle begin! Pfizer is currently trading at $53 and is up over 53% year to date. Over the last 5 years, Pfizer is up over 75%. Our second competitor, Bristol Myers Squibb, is currently trading at $64.99 and is up just over 3% this year. And over the last 5 years, Bristol Myers is up just under 26%. Rounding out the three, Merck is currently trading at $78.56 and is up over 7% this year. Over the last 5 years, Merck has seen a 28% increase. Now let's take a look at which combatant may perform better going forward based on its current valuation. The first item to compare is market cap. Market capitalization, commonly called market cap, is the market value of a publicly traded company's outstanding shares. Market capitalization is equal to the share price multiplied by the number of shares outstanding. Market cap is probably the least important metric in Stock Wars, but it is an indicator of public opinion of a company's net worth and is a determining factor in some forms of stock valuation. From a market cap perspective, there is no comparison here. Pfizer is the largest company with $299.6 billion compared to $142.2 billion for Bristol Myers, and rounding out the three is Merck at $199.5 billion. All three are dividend stock favorites, but Pfizer takes the first metrics comparison in this Stock Wars battle with over $150 billion more in market cap. The second Stock Wars metric comparison is revenue. Revenue is the income generated from normal business operations. It is the top line or gross income figure from which costs are subtracted to determine net income. Who generates more revenue in this epic stock wars showdown? In 2020, Pfizer had $41.9 billion in revenue, while Bristol Myers came in at $42.5 billion, while Merck rounded out the three with $47.9 billion in revenue. Merck wins its first metric in this battle. The third metrics comparison in stock wars is further down on the income statement. Net income or profit. Profit describes the financial benefit realized when revenue generated from a business activity exceeds the expenses, costs, and taxes involved in sustaining the activity in question. For the second time in the stock wars battle, Pfizer takes the win with $9.6 billion in profit, while Bristol Myers came in at negative $9.01 billion and Merck rounded out things at $7.06 billion. Knowing the profit for each combatant transitions into the next metric in this stock wars comparison. Profit margin. Profit margin is one of the commonly used profitability ratios to gauge the degree to which a company or business activity makes money. It represents what percentage of sales have turned into profits or losses. Pfizer comes in with a profit margin of 22.9%, while Bristol Myers is at negative 21.2% and Merck is at 14.7%. For this metric, Pfizer wins again. As the stock wars rage between these three competitors, the fifth metric is in sight: 3-year revenue growth. Revenue growth illustrates sales increases or decreases over time. It is used to measure how fast a company is expanding or contracting. Pfizer comes in with a 3-year revenue growth of negative 5%, while Bristol Myers is at 14.4% and Merck is at a lower 9%. Bristol Myers Squibb wins this metric. As the three healthcare titans battle for dominance, PE ratio emerges as the sixth metric in stock wars. The price to earnings ratio is a ratio for valuing a company that measures its current share price relative to its per share earnings. The price to earnings ratio is sometimes known as the price multiple or the earnings multiple. When examining the forward PE, Pfizer comes in with a metric of 9.3, while Bristol Myers boasts a forward PE of 8.13, and Merck at a higher 10.82. Bristol Myers comes out on top for the second time in this stock wars matchup. As the battle rages between these healthcare companies, dividend yield is the next metric in stock wars. The dividend yield, expressed as a percentage, is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. Pfizer comes in with a dividend yield of 3%. Bristol Myers sees a higher 3.37 yield, and Merck comes in with a yield at 3.49%. Merck wins this stock wars metric. Continuing on, the next metric is years of consecutive dividend increases. Companies with a track record of dividend increases tend to be more stable and motivated to maintain that track record. When analyzing the three combatants, Pfizer boasts 10 years of dividend growth, while Bristol Myers and Merck come in at 30 years, respectively. In this battle, Bristol Myers and Merck tie for this stock wars metric. Now on to 5-year dividend growth, which is the next metric in this stock wars battle between these healthcare leaders. The dividend growth rate is the annualized percentage rate of growth that a particular stock's dividend undergoes over a period of time. Many mature companies seek to increase the dividends paid to their investors on a regular basis. According to Fidelity, Pfizer has a 5-year dividend growth rate of 5.92%, compared to Bristol Myers at 7.28% and Merck at 7.98%. Merck claims another metric in this stock wars matchup. This begs the question for the next metric: how safe are the dividends? The Dividend Safety score system takes into account more than a dozen fundamental metrics that influence a company's ability to continue paying dividends. According to Simply Safe Dividends, Pfizer has a score of 75, which is considered safe. On the other side of the trio, Bristol Myers has a score of 79, which is also considered safe, and Merck rounds out the three at 99, which is considered very safe. Merck wins another Stock Wars metric. The 11th metric in the Stock Wars contest also reflects on dividend safety, the payout ratio. The payout ratio is a financial metric showing the proportion of earnings a company pays shareholders in the form of dividends. This is expressed as a percentage of the company's total earnings. Currently, Pfizer's payout ratio is at 48.19%, while Bristol Myers is at 27% and Merck rounds out the three at 44%. All three payout ratios are respectable, but Bristol Myers is the winner of this Stock Wars metric and takes another victory. Moving on quickly to the 12th metric, the three healthcare giants will compare current ratios. The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. It tells investors and analysts how a company can maximize their current assets on the balance sheet to satisfy their current debt and other payables. Pfizer comes in with a current ratio of 1.18. Bristol Myers, on the other hand, sees a current ratio of 1.36, and Merck rounds out the three at 1.31. The higher the current ratio, the better. Therefore, Bristol Myers takes another Stock Wars metric with a slightly higher ratio. The last metric is the debt-to-equity ratio in this Stock Wars contest. The debt-to-equity ratio is calculated by dividing a company's total liabilities by its shareholder equity. These numbers are available on the balance sheet of the company's financial statements. Pfizer sees a debt-to-equity ratio of 0.51. Bristol Myers comes in at 1.23, and Merck at 0.74. While all are over 0.5, which means their assets are financed by debt, Pfizer gets the better of this metric and wins another one. In this Stock Wars battle, Bristol Myers and Merck both won 5 metrics compared to Pfizer that won 4. Therefore, Bristol Myers Squibb and Merck are the winners of this epic Stock Wars battle between the three healthcare sector dividend favorites. Bristol Myers and Merck tie from an overall Stock Wars contest from a metric standpoint in a close contest between these three. Currently, Bristol Myers Squibb is considered the best value of the three. If you missed the first 12 episodes of Stock Wars matchups, please check them out and let me know what you think. I'll leave links in the description. Stay tuned for future Stock Wars episodes and please like, subscribe, and turn on the bell notifications so you don't miss any future episodes. Comment below if there's a particular battle you'd like to see. Until next time. Remember, I am not a financial advisor. The opinions expressed in this video are solely for educational and entertainment purposes. Any stock purchases I show on video should not be considered an investment recommendation. Investing involves risk, and you should do your own research. For investment advice, please seek the counsel of a financial investment advisor.